Hello and welcome to the Millennium Investing channel, Channel MI, a channel which is going to document my journey as a young investor as well as share ideas on the market. It will also mention and discuss certain stock picks and trends. I really want this channel to be as interactive as possible, so please comment your thoughts on all the ideas discussed in the videos. It'd be great to hear other people's views on whether you think these are good choices or bad choices and why. This particular video is the first in a new series of 10 in 10 videos whereby I plan to run through 10 stock picks in different market sectors or different geographies, to target different portfolio strategies, i.e. dividend stocks or growth stocks or spec stocks. And the aim is to run through the 10 stocks on a really high level, just explain why I'm watching them or whether I bought them already or not, and hopefully give you ideas if they aren't already stocks on the watch list. I'm going to try and keep these videos to as close to 10 minutes as possible. It's obviously going to be close to as 1 minute a stock as possible, plus obviously the introduction, a bit of a roundup at the end. So without any further ado, let's get stuck in. So I have made a watch list on the Trading 212 app, as you can hopefully see on the left hand side of the screen there. So best UK dividend stock watch list. So let's start at the top. So Plus 500 is the first one. So Plus 500, as some of you may know, is an online trading platform, not dissimilar from Trading 212, albeit it specialises in CFDs, contract for difference, the murky world of. If you're not familiar with them, definitely do your research before getting stuck into them. I know a lot of people have lost a lot of money on those, purely because they use leverage and they haven't fully understood what that means. But it's a great platform, really good in terms of information for those that haven't used it. Really high level analytics on companies' trends, past performance, key financial information, so the balance sheets, the income statement, similar to Trading 212. The reason I think this is a good stock and the reason I've included it on the list is because the industry is growing massively. So the popularity of these, predominantly within young people, is going from strength to strength. The traditional brokerage where you're paying for the privilege to buy and sell stocks is slowly diminishing, and a lot of those companies are having to get a lot more competitive on pricing to try and compete with apps such as Trading 212 and Plus 500. For that reason, I can only see it growing. I can only see it subscription-based growing. I expect it to grow into the future. So really good upward trend there. Dividend yields currently 4.16, which is really strong. Sensible PE ratio for stock of this type. In terms of its charts, had a fairly poor year in 2019 in comparison. So probably need to look into why that was. But a fantastic profit margin, 42-43%, which you do tend to see higher profit margins on service-based companies who don't have the ongoing overheads that other companies that provide products will obviously do in manufacturing costs and all that sort of stuff. Balance sheet great, really low debt to assets. Again, service companies do tend to have better balance sheets. So that's number one. Number two, Avast. For those of you that don't know what these guys do, they are a cybersecurity company who provide computer and browser security, as well as antivirus software, both for computers and mobile devices. Cybersecurity is clearly a growing market. More people relying on the internet for banking online and shopping online, as well as more and more people working from home remotely. This industry is only growing, so expect this to continue. Please, as I've mentioned in the previous video, do look at their long-term graph. Trading 212 does sometimes have a shortened version and doesn't capture all the sort of historic information, so do look that up online if you're interested in these guys. Dividend yield 2.53 for a growth stock, I think is pretty good. Income statement growing, really good profit margin. We just have a look in here. Growing total revenues from 650 million in 2017 up to 871. Growing their net profit every year, so really good trend there. Balance sheet good debt to assets, and increasing cash flow from operations, which is what we want to see. So all in all, a pretty good company, and that makes it on the list. Number three, Ashti Group. Ashti Group, for those that don't know, are an equipment rental company. So their Main business you will probably know as A-Plant. So these are the parent company of those guys. Again, fantastic business, growing rapidly. They provide a lot of the sort of heavy-duty machinery, which is not efficient for people to buy when they're only going to use it once or twice. Fantastic rebound during COVID for these guys. I know they had a contract with the NHS to provide a lot of the containers which they use for the mobile testing centres nationwide, so they did do well out of that. If we go down and have a look at some of the key ratios, low PE, dividend yield is slightly lower than maybe in comparison to some of the other stocks, but it's growing. 1.56 again for a growth stock I don't think is ridiculous, and if you can get in early on this stock, I think that's only going to grow over the years. Income statement, really solid, growing revenues, growing income, decent profit margin. Balance sheet, really good, and cash flow strong. So really good business, and one makes it on the list. Number 4, the first one actually that I currently hold in the portfolio. All of these on the list I would like to hold. The timing hasn't been right, or I prioritise other stocks when buying. So this is the first one I do currently own, which is Barclays. I did manage to get in when it sort of tanked in March and got a pretty low price on this, which I'm happy with. The reason I went for this, especially over some of the other UK banks, is because it has quite a large investment banking division. I think the biggest out of all the UK banks, which means it tends to make a lot of its revenue from investment banking and doesn't rely as heavily on loans and mortgages and all that sort of stuff. So it does still have exposure, but it's a bit more diversified from where its revenue is coming from. In terms of PE ratio, really, really low, 5.74. If you have watched my previous videos, you know that I do like to value banks on a price to book ratio. 0.33 again, really, really low. If you consider 1 is the fair value on a price to book. Dividend yield 2.28, fairly low in relation to a lot of banks, but given the concern people do have over the banking sector generally, I do actually feel comfortable with a slightly lower yield on banks. I feel like some banks do overstretch themselves from that perspective. If you look at the payout ratios as well for Barclays, around 50%. Last fiscal year, 50, trailing 12 months, just short of 60%. So a very sensible payout ratio. You will find other banks have got a slightly higher one. So in summary, I've gone for Barclays because it's a little bit more diversified than the bank. Its dividend yield is slightly lower, but its payout ratio is low in comparison to other banks, making it a safer dividend. And its price to book is also really, really low. And that is number 4. Stock number 5 on the list is Persimmon, a house builder for those of you that don't know. Again, in a growing market, really good upward trend. House building over the COVID period is obviously ground to a halt. A lot of construction sites were closed, but that is going to open up. I think they are actually back on site now. They were one of the last industries to close down. They're one of the first back, which I think tells you the importance that the government places upon them. Despite COVID going on, there is still a housing crisis in the UK. There is still a massive undersupply of housing, and so I expect Persimmon and the other house builders, Barratt Homes, Taylor Wimpey, to have a really good 5 years and make the most of some of the government incentives for those guys to keep building, and I expect their share prices and profits to continue to grow. So in terms of the numbers, sensible PE ratio, really good dividends, 4.33%, albeit I think this is currently being suspended. So look into that. I think it might be suspended till next year. But if you can get in now, lock that in, you will see some capital appreciation on these, I suspect, as well as receiving that dividend maybe slightly further down the line. Profit margins are good for house builders, slightly higher than some of the other ones at 23%. Balance sheet also really good, really low debt to assets. We just have a look in here. 850 million of cash and short-term investments, no short-term debt and no long-term debt. So a fantastic balance sheet. £850 million of cash with no short or long-term debt is a really good position to be in. And that is why Persimmon makes the list. Okay, number 6, primary healthcare prop. So for those that don't know, PHP is a REIT, effectively. that specialises in healthcare properties. So again, healthcare, a growing segment of the market. The only REITs I hold in my portfolio are industrial REITs and healthcare REITs. And the healthcare REIT I currently hold is Omega Healthcare, just because it had a higher dividend yield. I would prefer to have primary health prop because I just think it's a better, stronger, more stable company, but it's too expensive at the time. So really good trend. We go down to have a look at the key ratios. Dividend yields 3.69, which is strong. P ratio is high. Similar to banks, I like to value my REITs on price to book. So we have a look at price to book, 1.51. Tells me it's slightly overvalued at the moment. What have I got in here? A price alert of 145, so I really want it to be dropping towards its sort of lows of COVID before I consider entering this one. If we look at the income statement, big loss in 2019, so you'd have to do some digging and work out why that was. I suspect due to investment in new purchases, otherwise the very stable company. Debt to assets, again, really good. Low debt to asset ratio, so that is why primary health prop is on the list. Diageo, a beverage company which specialises in spirits and beer primarily, so some of their brands I think include Smirnoff and Ciroc on the vodka side. They've got some really good beers as well, really good brands, obviously sell internationally, really good market share, really good price trend going up, took a hit from COVID, hasn't recovered quite as quickly as some of the other ones, so maybe a decent opportunity to still buy into this one. Go down, sensible P ratio, dividend yield 2.4, which I think is pretty good. Payout ratio is very sensible, 51 for the last fiscal year and only 33% for the trailing 12 months. So really safe dividend there. If we look at the income statement, really good. High profit margin, 25%. You can see the size of the company here as well, nearly 13 billion in revenue. So pretty chunky company. Debt to assets, again, very good, 73%. And a very stable cash flow. Number 8, Unilever. A lot of people know Unilever. They'll know of all their brands. A lot of people are surprised as to just quite how many brands Unilever do own. So they're obviously huge in the consumer staples market. They own brands such as Surf is on here, Dove, Lipton, Hellmann's. So really good brands which a lot of people use, household names in a number of different sectors, which makes them a really diversified company. Really good long-term trend on the charts. Again, took a hit from COVID and haven't recovered quite as quickly as some of the other companies in the similar market. So the likes of Johnson & Johnson and Procter & Gamble, companies which are highly regarded as very defensive, recession-proof stocks, have fared a lot better, which is interesting. I still consider Unilever slightly undervalued. I've only got a small position in this one. I would like to bulk that up. Very sensible PE and a good dividend, 3.25%. Profit margin slightly lower than you'd like, but very stable. Consistent revenues, consistent balance sheet as well, and consistent cash flow. A company that's not going anywhere for the next 20 plus years. The penultimate stock on the list is Tritax Big Box REIT. For those that have watched my previous videos, you'll know this is one of my favourites. It is the second REIT on the list after PHP. Tritax specialises in industrial properties, primarily big box industrial properties, hence the name. So their speciality is big distribution centres for all the retailers and 3PLs, and they boast some huge tenant names on their portfolio list. I think they've recently done a couple of deals with Amazon, who now take up a decent percentage of their weighting on portfolio. So we go down and have a look at some of the ratios. Sensible PE, really strong dividend yields, 4.6. I did manage to get in to this stock when they were a lot lower, and I think my dividend yield is actually close to 5.5%, which is great. Really good income statement, really sensible balance sheet, very low debt, and again in a growing market with a lot of consumer buys moving online, whether that's your shopping, your food shopping, or your retail shopping. All that is dealt with at distribution centres, which these guys own and rent. So growing market, which I think is only going to go one way in the future. Finally, the final pick, number 10, one of my favourites, 3i Infrastructure. This is a closed-end investment trust, so make sure you do some research on that if you don't know what it is, and make sure you're comfortable with it. But yeah, these are a fantastic company. They basically invest in mid-market economic infrastructure in developed markets. And their strategy, if you look on their website, is to maintain a balanced portfolio of investments to deliver an attractive mix of both income and capital appreciation for their shareholders. The bulk of their investments, if you look on their website, is in sustainable infrastructure projects, longer term future trends. So I think they own a couple of sort of energy from waste plants, some renewable energy companies. So really interesting company, which again, I only see going one way in the future. PE ratio low, dividend yield good at 3.36. Do note there is a management charge on this, so I think your net receivable yield is probably close to 3%. Really good income statement, fantastic balance sheet, really good company. I have initiated a recent position, not as low as I would like, and I will be adding that if it drops, but I'm expecting this to do really well for me over the near future. So that wraps up the video of the 10 in 10. I think my portfolio currently has 5 or 6 of these. I would like to get all 10 in there if I possibly can. Clearly subject to market pricing and whether I can pick these up at a good price or not. I hope you found this video interesting. Please do like, subscribe and comment below your thoughts on whether you think these are good picks, bad picks, what you think should be in there, what you think shouldn't be in there. I really do want this channel to be as interactive as possible, so please let me know your thoughts. Otherwise, I'll see you in the next one. Cheers.